Hi everyone, welcome to the Vincents Tax and Superannuation Quarterly Update for the April to June 2017 quarter. You are joined here today by myself, Katrina Brennan, Director in Business Advisory, and Maylene Wheeler in Superannuation Advisory, a manager there. First of all, I'll be covering off on the tax updates for the quarter, and then Maylene will cover off in the second part of the superannuation updates. So just a bit of a picture of ourselves and our contact details. You can use these details at the end if you have any questions throughout or at the end where you want to make contact with us about any topics that we've brought up or anything we haven't brought up. You can contact us on our direct lines or on email. So I'll get started. So just covering off on some of the changes to the thresholds. The car parking threshold for the FBT year that commenced on the 1st of April 2017 is now $8.66. The luxury car tax determination, the threshold for the 16-17 financial year is $65,094. The determination also, though, states that the fuel efficient car limit for the 17-18 financial year is $75,526. So the depreciation car limit for the 17-18 financial year is $57,581, and the cents per kilometre rate for work-related motor vehicle expenses for the year commencing 1st of July 2017 is 66 cents, but this is actually the same rate as the 16-17 year. So next up we have Division 7A benchmark interest rates for the 17-18 year. The benchmark interest rate for the purposes of the deemed dividend rules in Division 7A is expected to be 5.3% for the 17-18 income year. This is actually down from the 16-17 year, which was 5.4%. So then just touching on the reasonable travel and meal allowances for the 17-18 year. So the overtime meal allowance expense for the 17-18 is now $30.05. Domestic travel allowance expenses, so within the determination, reasonable amounts are given for accommodation at daily rates for domestic travel only, meals showing breakfast, lunch and dinner, and deductible expenses incidental to travel. The travel allowance expense for employee truck drivers, the reasonable amount for food and drink is now $55.30 per day. And for memory, this has actually dropped quite significantly in comparison to the year before. Overseas travel allowance expenses are also listed. Now, this is just a table for you to have a look at. I won't go through all of them. It's basically just a determination in relation to what the Commissioner will accept for the 16 and 17 year as estimates of the value of goods taken from trading stock for private use by taxpayers in certain industries. So it's covering off on bakeries, butcher, restaurant, cafes, licensed and unlicensed, caterers, delicatessens, fruiterers, greengrocers and takeaway food shop. So just looking there, it's got the two columns, one which basically states the amount, the estimate that the Commissioner would accept for an adult child over 16 years. So for example, a bakery, the amount is $1,350. But for a child ranging between 4 to 16 years, it's only $675. So I won't run through all of the amounts, but the amounts are just listed there for the different types of businesses. Also just have a table which outlines the changes to the repayment amount and repayment rate for HELP, SSL, AB study and TSL repayment thresholds and rates. So basically anything below 55,874, the repayment rate is nil. And then it goes up in increments. So basically between 55,874 and 62,239, you have a rate of 4%. This then goes up in increments to any amounts over 103,766. The repayment rate is 8%. And basically anything above that amount, it stays at 8%. So more changes to thresholds. We have the Medicare levy low income threshold for 16 and 17. So the individual income threshold for the 16-17 income year is 21,655. The family income threshold for the 16-17 income year is 36,541. So the child student component of the income threshold for families and for SAPTO families is $3,356 for the 16-17 year. The threshold for individual taxpayers eligible for the SAPTO for the 16-17 year income year is $34,244, and the threshold for families will be $47,670. So the low income tax offset basically remains unchanged, not changed for the year. So the amount is $445. The lower withdrawal limit is $37,000 and the upper withdrawal limit is $66,667, and the withdrawal rate is 1.5%. So the 2017-18 budget contained no changes to the personal income tax rates and thresholds. This means that the 2% budget deficit levy on income over $180,000 will not be extended beyond its initial 3 years. So the levy will therefore cease at the end of 16-17 financial year for the 2% budget deficit levy. So while the income thresholds for the private health insurance rebate have been frozen until 1st of July 2018, the rebate percentages continue to be adjusted annually on the 1st of April. So the Department of Health has released private health insurance rebate percentages effective from the 1st of April 2017 to the 31st of March 2018. Foreign residents, the tax rates for 17-18 will be the same, except that the top marginal rate will be 45%, reflecting the removal of the 2% temporary budget deficit levy. So the ATO, what they will focus on in the 16-17 tax returns when lodging is, once again, we have work-related deductions. So the ATO said it will be paying extra attention to people whose deduction claims are higher than expected, in particular those claiming car expenses, including those for transporting bulky tools, and deductions for travel, internet and mobile phone, and self-education. So the rental property owners as well, the ATO will be paying close attention to excessive interest expense claims and incorrect apportionment of rental income and expense between owners. The corporate tax rates. So in the 16-17 financial year, the reduced corporate tax rate of 27.5% will apply for businesses with an aggregated turnover of less than 10 million. So 25 million turnover in the 17-18 year and 50 million turnover from 18-19. So this effectively implements the first 3 years of the government's 10-year plan for the company tax cuts. Next, I'm just going to touch on travel expenses related to residential rental properties will be disallowed. So deductions for travel expenses relating to inspecting, maintaining or collecting rent for a residential rental property will be disallowed from the 1st of July 2017. This is an integrity measure to address concerns that many taxpayers have been claiming travel deductions without correctly apportioning the costs, or have claimed travel expenses that were for private travel purposes. So this measure will not prevent investors from engaging third parties such as real estate agents for property management services. So these expenses will remain deductible. Next, we have the changes to the family tax benefit, Part A. So the budget confirmed that from the 1st of July 2017, family tax benefit Part A supplement payments will be reduced by $28 per fortnight for each child who does not meet the government immunisation requirements. Changes to dollar income test taper. So the government will implement a consistent 30 cents in the dollar income test taper for family tax benefit Part A families with a household income in excess of the higher income free area. So that's currently $94,316 from 1st of July 2018. This will ensure that higher income families are subject to the same income test taper rates. And the proposed Part A rate increase is not going to proceed. So the government will achieve savings of $1.9 billion over 4 years from 17-18 by not increasing the maximum rate of family tax benefit Part A, which is unfortunate for the families. Some small business updates. So the small business CGT breaks are to be tightened. So access to the small business CGT concessions will be tightened from the 1st of July 2017 to deny eligibility for assets which are unrelated to the small business. So the concession assists owners of small businesses by providing relief from CGT on assets related to their business, which helps them to reinvest and grow, as well as contribute to their retirement savings through the sale of the business. However, some taxpayers are able to access these concessions for assets which are unrelated to their small business. So, for instance, through arranging their affairs so that their ownership interests in larger businesses do not count towards the test for determining eligibility for the concessions. So the small business CGT concessions will continue to be available to small business taxpayers with aggregated turnover of less than $2 million or business assets of less than $6 million. So the instant asset write-off is extended for 12 months, which is good. The $20,000 instant asset write-off for small business will be extended by 12 months to the 30th of June 2018 for businesses with an aggregated annual turnover of less than $10 million. So small businesses will be able to immediately deduct purchases of eligible depreciating assets costing less than $20,000, provided they are first used or installed ready for use by 30 June 2018. Only a few assets are ineligible, and these are horticultural plants and in-house software. So depreciating assets valued at $20,000 or more, which cannot be immediately deducted, can continue to be placed into the general small business pool and depreciated at 15% in the first income year and 30% for each income year thereafter. The pool can also be immediately deducted if the balance is less than $20,000 over this period. So this includes existing pools. So the current lockout laws from the simplified depreciation rules will continue to be suspended until 30 June 2018. These rules prevent small businesses from re-entering the simplified depreciation regime for 5 years, and if they opt out. From 1st of July 2018, though, the immediate deductibility threshold and the balance at which the pool can be immediately deducted will revert to $1,000. So this measure is designed to improve cash flow for small businesses, providing a boost to small business activity. And investment for another year. So It is estimated to have a cost of revenue of 650 million over forward estimate periods. So just some various updates. The depreciation deductions are limited for residential rental properties. So plant and equipment depreciation deductions will be limited to outlays actually incurred by investors in residential real estate properties from the 1st of July 2017. So plant and equipment items are usually mechanical fixtures or those which can be easily removed from a property, such as a dishwasher or ceiling fans. This is an integrity measure to address concerns that some plant and equipment items are being depreciated for successive investors and in excess of their actual value. So acquisitions of existing plant and equipment items will be reflected in the cost base for the capital gains tax purposes for subsequent investors. So these changes will apply on a prospective basis, so with existing investments grandfathered. So plant and equipment forming part of residential investment properties as of the 9th of May 2017, including contracts already entered into on the 9th of May 2017, will continue to give rise to deductions for depreciation until either the investor no longer owns the asset or the asset reaches the end of its effective life. So investors who purchase plant and equipment for their residential investment property after the 9th of May 2017 will be able to claim a deduction over the effective life of the asset. However, subsequent owners of a property will be unable to claim deductions for plant and equipment purchased by a previous owner. Next up, we have CGT main residence exemption removed for foreign and temporary residents. So individuals who are foreign or temporary tax residents will no longer have access to the CGT main residence exemption from 9th of May 2017. Existing properties held before this date will be grandfathered until the 30th of June 2019. Capital gains withholdings clearance on disposal of real property by foreign residents. From 1st of July 2017, the scheme will be modified. So the threshold, the contract price, is lowered to $750,000. It was previously $2 million. And the withholding tax rate has increased to 12.5% when it has previously been 10%. Next up, we have the double taxation of digital currency has been removed. So the GST treatment of digital currency, such as Bitcoin, will be aligned with that of money from 1st of July 2017. So the digital currency is currently treated as intangible property for GST purposes. Consequently, consumers who use digital currencies as payment can effectively bear GST twice. Once on the purchase of the digital currency and again on its use in exchange for other goods and services subject to GST. This measure will ensure purchases of digital currency are no longer subject to GST. Removing double taxation on digital currencies will remove an obstacle for the financial technology fintech sector to grow in Australia. There will also be a major bank levy that's going to be introduced. So it'll be introduced for authorised deposit-taking institutions, so ADIs, with licensed entity liabilities of at least $100 billion from 1st of July 2017. So the $100 billion threshold will be indexed to grow in line with nominal gross domestic product. The levy will be calculated quarterly as 0.015% of an ADI's licensed entity liabilities at each quarterly reporting date mandated by APRA. So this equates to an annualised rate of 0.06%. Liabilities subject to the levy will include items such as corporate bonds, commercial paper, certificates of deposit and Tier 2 capital instruments. The levy will not apply to the following liabilities, so additional Tier 1 capital and deposits of individuals, businesses and other entities protected by the financial claims, and it will not be levied on mortgages, which is important. And superannuation funds and insurance companies will not be subject to the levy either. Next, the ATO will be aligning tax treatment of roll your own tobacco and cigarettes. So the taxation of roll your own RYO tobacco and other products, example cigars, will be adjusted so that manufactured cigarettes and RYO tobacco cigarettes receive comparable tax treatment. So this will be achieved by calculating the per kilogram excise and excise equivalent customs duty rates on the assumption that the average tobacco content of a cigarette is 0.7 grams rather than the current assumption of 0.8 grams. So since the average cigarette contains less than 0.8 grams of tobacco, the current tax treatment of RYO tobacco is relatively more favourable. So the adjustment will be phased in over 4 years from 2017 to 2020 to match the timing of the previously legislated 12.5% tobacco tax increases, which occur on the 1st of September each year. The first of the 4 annual tax changes will occur on the 1st of September 2017. And on my last update, there is funding to address serious and organised tax crimes. So the government will provide $28.2 million to the ATO to target serious and organised crime in the tax system. This extends an existing measure by a further 4 years to 2021. This measure is estimated to have a gain to revenue of $408.5 million and net gain to the budget of $380.3 million over the forward estimate periods. So the ATO's compliance work is currently funded to 30 June 2017. And that basically covers everything that I wanted to chat about. So I might just hand you over to Maylene, who's then going to cover off on the superannuation updates from April to June 2017. Thank you.
Thanks for that, Katrina. All right, let's get started on the superannuation updates. Oops, and there I am getting too excited. Apologies for my technical issues. All right, so as part of the June quarterly superannuation update, we're going to briefly look at some of the announcements that happened with superannuation measures in the May 2017 federal budget. We're going to look at the amendments to the superannuation reform legislation and the changes to the superannuation rates and thresholds that apply for the 2017-2018 year. We're also going to look at some of the law companion guides that have been finalised since our last quarterly tax update, and we'll discuss the relevant practical compliance guidelines that have been issued in the quarter. All right, so firstly, let's briefly touch, oops, my slide has disappeared. Missing a slide here, but I'll just fill you in briefly on what's happened with some of the budget announcements for superannuation. So what we have first is we have the introduction of the first home super saver scheme. So from 1 July 2017, eligible individuals can make voluntary super contributions of up to $15,000 per year and up to $30,000 in total, which can be saved for the purposes of buying a first home. So the contributions are treated as concessional or before tax contributions and will be taxed at 15%. The withdrawals, including earnings, are permitted to be withdrawn after 1 July 2018, and they'll be taxed at the person's marginal tax rate less a 30% tax credit. Alternatively, an individual can make non-concessional or after-tax contributions, and such contributions are not taxed when withdrawn from the super fund. We also had another measure that they proposed of an incentive for over 65s to downsize by permitting extra super contributions. So from 1 July 2018, it is proposed that Australians aged 65 years or over will be able to contribute the proceeds from the sale of their family home of up to $300,000 per individual or $600,000 for a couple, without having to satisfy a work test and without having to worry about the 100,000 non-concessional contributions cap. In addition, individuals with a total super balance of more than $1.6 million will still be able to make the superannuation contribution under the downsizing policy. Should be noted that under the current proposals, the family home must be held for at least 10 years in order to qualify for this incentive. So we have on 22nd of June, the Treasury Laws Amendment 2017, Measures Number 2 Bill, receiving royal assent as Act Number 55 of 2017. The bill amends the superannuation reform legislation in relation to the transfer balance cap, concessional and non-concessional contributions, limited recourse borrowing arrangements, the objective of superannuation, transition to retirement income streams, capital gains tax relief for super funds, and administrative processes. Of note is the change regarding pension balance credits for LRBA repayments. Okay, so what will happen is that the amendments provide that an additional pension transfer balance credit will arise for certain repayments of a limited recourse borrowing arrangement by an SMSF that shifts value between an accumulation phase interest to a retirement phase superannuation income stream interest in the fund. It makes amendments to ensure that SMSF members are not able to use an LRBA to facilitate the payment of retirement phase liabilities from accumulation phase income. This is achieved through the amendment of Section 294(25) of the Income Tax Act 1997 to include the repayment of an LRBA as a transfer balance credit. And there will be an amendment of Section 294(55) which defines the repayment of an LRBA. These LRBA integrity measures apply from 1 July 2017 to new contracts entered into on or before 1 July 2017. These changes do not apply to pre-1 July 2017 LRBA contracts, pre-1 July 2017 LRBA contracts where the borrowings have been refinanced, or contracts entered into before 1 July 2017 that were settled after this time. All right, so we have some changes to the contributions caps that take effect from 1 July 2017. So from 1 July 2017, the general concession contributions cap will be $25,000 for all individuals regardless of age. The 10% work test for claiming deduction for personal super contributions has also been removed. This provides most taxpayers under the age of 75 to claim a tax deduction for personal super contributions made to an eligible super fund or RSA. This means that an individual can pretty much make up the difference between their super cap of $25,000 and the employee superannuation guarantee payments that have been made during the year, and they'll be able to claim this as a tax deduction. Taxpayers aged 65 to 74 are still required to meet the work test, which requires that they work for a minimum of 40 hours and a 30-day consecutive period within the financial year before the superannuation fund can accept the contribution. If you are over 75 years or older, you can only claim a deduction for contributions you've made on or before the 28th day of the month following the month in which you turned 75. Members of a Commonwealth Public Sector Fund, public super scheme, an untaxed fund such as a constitutionally protected fund, or certain funds that offer defined benefit income interests will not be eligible to claim a tax deduction contribution for contributions made to these funds. If you're a member of one of these funds and you wish to claim a deduction, you can choose to make a personal super contribution to another eligible fund. The non-concessional caps. So from 1 July 2017, the non-concessional cap has been reduced from $180,000 to $100,000 for members 65 or over, but under age 75. Non-concessional contributions caps will be nil for a financial year if you have a total superannuation balance greater than or equal to the general transfer balance cap at the end of 30 June of the previous financial year. For the 2017-28 financial year, the general transfer balance cap is $1.6 million. If you have a balance of more than $1.6 million at 1 July 2017, then you will not be able to make further non-concessional contributions. In this case, if you do make non-concessional contributions in that year, they will be treated as excess non-concessional contributions. When approaching the $1.6 million cap, care needs to be taken with the bring forward rules, as these are restricted by the new $1.6 million balance cap. Okay. So the non-concessional contributions cap amount that you can bring forward, and whether you have a 2 or 3 year bring forward period, depends on your total superannuation balance at the end of 30 June of the previous financial year. Special transitional arrangements apply to individuals who brought forward their non-concessional contributions cap in the 2015-16 or the 2016-17 financial years, and they did not fully use the bring forward amount before 1 July 2017. This means that the maximum amount of bring forward available will reflect the reduced annual contributions caps. The maximum bring forward amount that can be used is shown in the next slide. So you'll see that if you triggered your bring forward period in the 15-16 year, that the maximum bring forward amount in the 2017-18 financial year is $460,000. If you triggered it in the 16-17 year, it's $380,000. And if you triggered it in the 17-18 year, it's $300,000. To work out your non-concessional cap for the year, just subtract any non-concessional contributions you have made during the bring forward period from your maximum bring forward amount. For 2017-18, to access the non-concessional bring forward arrangement, you must be under 65 years on the day during the triggering year, which is the first year, and your total superannuation balance must be less than $1.5 million at the end of 30 June 17. For the 2017-18 year, to access the non-concessional concessional bring forward arrangement, as I've said before, you must be under the 65 at that date, and your total super balance must be less than 1.5 million. The remaining cap for years 2 or 3 of the bring forward arrangement will be reduced to nil for a financial year if your total super balance is greater than or equal to the general transfer balance cap at 30 June of the previous financial year. So the table on this slide shows how the bring forward arrangement works. So if your total superannuation balance on 30 June is less than 1.4 million, the maximum non-concessional contribution cap for your first year is $300,000 and your bring forward period is 3 years. If your balance is between 1.4 million and 1.5 million, then the maximum is $200,000 and your bring forward period is 2 years. Where your balance is between 1.5 million to less than 1.6, it's $100,000 and no bring forward period or general non applies, and the general non-concessional contribution cap therefore will apply in this period. And as previously mentioned, where you're over 1.6, you can no longer make non-concessional contributions and the bring forward period is not applicable. Okay, so let's have a look at the other superannuation rates and changes that are applicable for the 2017 and 2018 year. So further to the changes to the contributions caps from 1 July 2017, the following key superannuation rates and thresholds for the 2017-2018 year were published by the ATO. Some of these rates and thresholds have been indexed in accordance with the average weekly ordinary time earnings figures released by the Australian Bureau of Statistics. For the superannuation guarantee, the maximum super contribution base is $52,760 per quarter. The CGT cap amount for non-concessional contributions is $1.445 million, and the Div 293 tax threshold amount has been reduced to $250,000. The employment termination payments cap amount for life benefit termination payments and death benefit termination payments is $200,000. In relation to the tax-free part of the genuine redundancy payments and early retirement scheme payments, the base limit for the 17-18 year is $10,155, with $5,078 for each completed year of service. Superannuation benefit caps, the low rate cap is now $200,000 and the untaxed plan cap amount is $1.445 million. The maximum superannuation co-contribution entitlement remains at $500. However, the lower income threshold increases to $36,813 and the higher income threshold increases to $51,813 for the 17-18 year. Right, so there's also been a change to the related party LRBA interest rate from 1 July 2017. In PCG 2016-5, the ATO set out the safe harbour interest rates for a related party, LRBA, which is used to acquire real property or listed securities. For the 16 and 17 and later years, the interest rate is set in accordance with the Reserve Bank's indicator lending rates for banks providing standard variable housing loans for investors. This rate is published in May, immediately prior to the start of the relevant financial year. Accordingly, the ATO safe harbour interest rates for 17-18 is 5.8% for real property and 7.8% for listed securities. All right, so the ATO issues law companion guides which give their view on how recently enacted law applies. With all the changes in superannuation, you can imagine that there have been quite a few of these floating around. So since our last quarterly tax update, the following LCGs have been finalised. We have LCG 2017-1, which clarifies how the defined benefit income cap applies to superannuation income stream pensions or annuities that are paid from life expectancy or market-linked products that are non-commutable. The guidance follows changes made to the income tax treatment of certain defined benefit income stream benefits from the 2017-18 financial year. Law Companion Guideline LCG 2017-3 provides guidance on tax and regulatory treatment of superannuation death benefits and the treatment of death benefit income streams under the transfer balance cap provisions. A superannuation death benefit is paid when a superannuation provider cashes out the remaining superannuation interest of a deceased member to their beneficiaries. The superannuation death benefits can be cashed to a beneficiary or beneficiaries as a lump sum, as a superannuation income stream that is retained in the superannuation system, or as a combination of both. A credit arises in the dependent's beneficiary's transfer balance account where the deceased member's interest is retained within the superannuation system and cashed to the dependent beneficiary in the form of a death benefit income stream. A transfer balance credit does not arise when the death benefit is paid out of the superannuation system as a superannuation lump sum. The LCG specifically deals with the following scenarios: a transfer balance credit that arises out of a reversionary death benefit income stream, transfer balance credit that arises for non-reversionary death benefit income streams, excess transfer balances, and superannuation death benefits as a superannuation rollover benefits. The changes to the tax and regulatory treatment of super death benefits and the treatment of the death benefit income streams under these transfer balance cap provisions have significant impacts on your estate planning affairs. It is important that you review and structure your superannuation appropriately now so that you can minimise the tax that will be paid in the future by your beneficiaries and maximise asset protection. Considerations include death benefit nominations and also the implication of those nominations, the tax implications for those beneficiaries. If you're in pension phase or about to commence a pension, you need to consider whether you will be doing a reversionary or a non-reversionary pension. We need to look at whether there are strategies that could be adopted to reduce the taxable component of your superannuation and therefore reduce the tax payable by any non-dependent beneficiaries. And you need to consider whether you should be holding your insurance inside or outside of super. As always, these issues will need to be considered alongside other wealth accumulation and asset protection objectives and should be discussed with the appropriate advisors. So please don't hesitate to contact our office should you wish to discuss the tax implications of your super estate planning further. Okay. Next, we have the practical compliance guidelines that have been dealt with in the June quarter. So from 1 July 2017, the superannuation fund members are subject to a $1.6 million transfer balance, which limits the tax exemption for assets funding superannuation pensions. Amounts in excess of the lifetime cap will not attract the tax exemption for earnings from assets in retirement phase and will be required to be held in an accumulation phase and taxed at 15%. The ATO released their Practical Compliance Guideline, PCG 2017-5, which outlines the requirements trustees must satisfy in creating pension commutation requests for SMSFs with members that have pension balances over $1.6 million. It noted that the documentation must have been completed before 30 June 2017. For the accountants listening, this is quite similar to the trust distribution minutes that you're required to prepare each year at 30 June, where you must nominate the beneficiaries and the amounts or percentages that they'll be receiving, even though you have no idea what the taxable or the accounting income will be. So under this practice guideline, it enables members to commute the excess pension holdings to avoid breaching the cap, even though the value of the holding and the amount of the commutation required may not be known until well after 1 July 2017. Instruction from the member was required to be dated and lodged with the trustee by 30 June 2017. Additionally, the trustees needed to acknowledge and accept this request in writing by a resolution by 30 June 2017. Our clients who've been impacted by the transfer balance cap would have been sent the relevant rollback documentation before 30 June. Where members have multiple superannuation interests, however, advice needs to be sought as to the order in which the superannuation interest should be rolled back. As a superannuation interest is a financial product, a statement of advice prepared by a licensed financial planner or advisor, which sets out the basis on which the advice is given, must be prepared when advising clients of the order in which the pensions should be rolled back. So if you or any of your clients are impacted by the transfer balance cap rules and you haven't completed the relevant commutation documentation, or you haven't determined the order in which they should be applied, please not hesitate to contact our office again, as there are definitely some tax consequences for exceeding the caps. So where you exceed the caps, breaches of the cap will require the excess amounts to be removed, which will most likely necessitate partial or even full commutation of the relevant income stream which has exceeded the cap. The ATO will issue a notice that the transfer balance cap has been exceeded, which will identify the excess. If the excess is rectified, then the taxpayer only needs to notify the ATO that corrective action has occurred. If not, the ATO will provide 60 days to reduce the transfer balance cap by the excess amount. After 60 days, the Commissioner of Taxation will issue a commutation notice setting out the amount and income stream must be reduced by the trustee to the trustee of the fund. A fund then has 60 days to comply with the commutation notice. If the commutation notice is not complied with, then the entire income stream will not be eligible for the tax exemption of earnings from assets supporting an income stream. So you're losing your tax-free status. Excess amounts will also attract notional earnings, which count towards the transfer balance cap. These notional earnings are charged at the 90-day bank accepted bill rate plus 7%. These notional earnings also attract tax at 15%. After you receive one excess transfer tax determination, a tax rate of 30% applies to any excess transfer balance tax assessments the individual will receive in subsequent financial years. PCG 2017-6, the ATO has released a practical compliance guideline on the superannuation reform measure. So it's the commutation of a death benefit income stream before 1 July 2017. An individual may choose to commute a superannuation income stream that is a superannuation death benefit or a death benefit income stream. If the individual was the spouse of the deceased member and certain other criteria are met, the individual may choose to roll over the commuted amount to or within a self-managed super fund for immediate cashing. This PCG outlines the circumstances in which the ATO will not apply compliance resources to review whether an SMSF has satisfied the requirement to cash out a death benefit in this situation where the rollover occurred prior to 1 July 2017. All right, the next slide is the stamp duty relief for New South Wales primary producers. So under new law, stamp duty for the transfer of business and land is not chargeable under the Duties Act New South Wales under Section 274. This law was extended in the New South Wales State Revenue Legislation Amendment Act 2017 to include intergenerational transfers of primary production land that is held by a self-managed super fund to a family member of the trustee. The enactment of this legislation removes another barrier, which is the large transaction costs of shifting property to other entities on concessional rates. So while this stamp duty concession only applies to New South Wales, in Queensland, there are other ways to minimise the impacts or remove stamp duty for similar transactions. Please feel free to contact our office if you'd like to discuss such strategies. And lastly, we have event-based reporting. So the final discussion point is around the ATO's proposal to introduce event-based reporting for SMSFs. There's been much media talk regarding the ATO's proposal to introduce event-based reporting for all SMSFs. This means that the funds will have to report certain events to the ATO in real time. The ATO has stated that, subject to some specific exceptions, most SMSFs will not need to report anything additional for the purposes of the super changes until the due date of the 17 annual return, indicating that event-based reporting could come into effect from 1 July 18. The specific requirements for events-based reporting under the pension transfer balance cap system have not yet been legislated. Under the proposed reporting requirements, some events like a commutation of a pension would be required to be reported within 10 business days after the end of the month in which that commutation occurs, and the commencement of pensions would need to be reported to the ATO within 28 days at the end of the quarter. This proposal signifies a significant move away from the traditional concept of preparing your financial statements and your records on an annual basis for your super fund, and you're going to be reporting in real time, or at the very least, on a quarterly basis. Trustees and members need to proactively seek advice before they commence a pension, as administrators and advisors will no longer be able to get away with retrospectively creating pensions. Trustees, administrators, and advisors will also need to make sure that the current record keeping and compliance processes are sufficient to meet these new proposed event-based reporting requirements. From our end here at Vincents and the super team, we've moved to a software system called Class about 18 months ago, which we think will allow our clients to be best placed to meet these future reporting challenges. Right, that concludes our tax update. Oh, sorry.
I will just slide in here. Thanks for listening, everyone. As I said at the beginning, if you have any questions that you would like to either email myself or Maylene about, there was a question in relation to will the slides be received. Not that I'm aware of, but possibly, if you were to email one of us, if there's any particular slides that you're interested in, we might be able to get copies of them. Or we also have our direct line on there as well. So thanks for listening, and I hope you all have a great afternoon. Bye.
Thank you.